The purpose of this video is to direct our followers to the North Star Quarterly Report, where we've written an article, The Big Picture, contextualizing investor pain on the JSE for the last 5 years. How bad has it been and why has it happened? What we know about markets is over time they outperform inflation. In the case of the JSE, it's outperformed inflation by a healthy margin of 7 to 8% annualized. What's equally important, however, is that there are periods where the market underperforms inflation. The attached graph highlights two important points. The first one is the long-term outperformance of the market against inflation. Note how much time the blue line spends above the orange line. So the market outperforms inflation by a healthy margin over time. However, the second point is, of late, on a 5-year rolling basis, the market has grossly underperformed inflation. What we show in the article is the interesting decade of performance divided into two 5-year periods with complete asymmetry of performance. The first 5 years, high performance coming out of the JSE, excellent returns out of our market. The back end, the last 5-year, terrible performance coming from the market. So having discussed how difficult the markets have been, the question really is, why did it take place? Why has it been as tough as it has been for investors? And we ascribe it to two reasons. Firstly, 5 years ago the market was expensive, trading at 19 times earnings. The second reason, and the one which we find more interesting, is the strong connection between nominal GDP and company profitability. Since 2007, company profitability has been falling, but so too has nominal GDP. And the reason for this is that companies cannot outgrow the economy forever. There's only so much self-help that they can impose on their businesses. Changing labor into capital, making acquisitions, exploring opportunities offshore, cutting costs, adding debt to the balance sheet. Those are internal levers that can be pulled, but ultimately companies need to grow with the economy. And what we're seeing very clearly is that as economic growth falters in South Africa, it is becoming quite apparent that company profitability is faltering too. And we haven't even shown in our latest graph the print of GDP of minus 3.2% that we've just seen. The graph work we did happened before this latest print. And what's quite clear is that company profitability lags GDP by 12 to 18 months. And with GDP having dropped to the extent it has of late, and company profitability still remaining relatively elevated, we see further downside pressure on numerous company profits that we're going to see coming out over the next year. So we're warning our clients that we have to be particularly careful where we invest on the JSE. We have to find high quality assets, high quality investments with strong balance sheets that can outmaneuver the current difficult climate. Given time, we think these companies will turn around, but we see more pressure in the short term. But here's some more interesting statistics about the market, the local market, over the last while. Some statistics to prove this point. For the first 5 years, the best performing companies did more than double the return of the best performing companies in the second 5-year period. Against this, the worst performing stocks in the second 5-year period did double as badly as the worst performing stocks in the first 5-year period. Then in terms of returns on the market, for the first 5 years, the annualized return from stocks was 20%. We compare that to the second 5-year period, the annualized return was 0. The average stock returned 0. From a hit rate perspective, for the first 5 years on the market, 83% of companies delivered positive returns over that period. For the second 5-year period, only 58% of companies returned positive returns. To compare that, for example, to the S&P, in the last 5 years, 78% of companies on the S&P have actually delivered positive returns. And those returns have been 9% annualized in dollars. This should give our investors some idea of just how difficult it's been to manage money on the local market.